Hi traders, it's Roberto. Today is Wednesday, November the 12th, and this is the Pro Traders Workshop Series continuation. And I'm going to go over again divergence setups. I know we went over this before, and there's two types of setups, and let me just go over the first one. Of course, as you know, let's just a brief review about how to spot divergence on a daily chart. And what I'd like to do is highlight these swing points and wave patterns. That's the first thing I'm looking for. Now, a few days ago, I noticed this wave being developed, but the two lines had not crossed to the upside yet. So this divergence was not complete. Now it is complete, and the market should continue to go up. I also draw a trend line. Now, the way I draw trend lines is that I connect the bodies of the candle, and we have, notice this body of this candle, and price has clearly broken the trend line. It's also broken a swing point, and this is very crucial. The swing point has been broken. Now, there's a possibility that the market will retrace to a support before it continues. But just the fact that it broke this trend line was enough for me, gave me enough confidence to take this trade and not wait for the retracement. Oftentimes you won't see a trend line break, but you'll see a swing point being broken, which confirms the uptrend, but then you have to wait for the market to retrace to take a trade. Instead, what I noticed that there was a trend line break, and that was enough for me. As long as price breaks a trend line, you don't have to use a divergence strategy to take a trade. Just a simple trend line break is enough to cause the market to continue in its uptrend. Now, the first target is that swing point, which is 79.23, and then the second target is right up here. It's that one about 0.80 or 79.95. I could also take my Fibonacci tool and draw it from this swing point here to the swing low, and 161 extension coincides with the swing point. So that's going to be a very difficult area to break. So that's my first target. Now, if the market closes, if the body of the daily candle closes above the 161% retracement level, most likely it will continue to go to 0.80. And why? Because a divergence on a daily chart is extremely powerful. It just indicates that the market is finished its downtrend and it's ready to go in the opposite direction. Now, there may be some retracements and the market may retest the lows, but the overall direction now is for the New Zealand dollar to go higher. Here's another trade, USD Canadian dollar, where we have wave patterns. This is going to be a short review on divergence. We have wave patterns going lower. Notice the wave here. Here's another wave. And then we have one more wave. Two lines in MACD have crossed the downside. We have price action and an uptrend. This swing point is higher than this swing point, and this swing point is higher than this swing point. So the swing points are going higher, but the wave patterns are going lower, hence we have divergence. Now, we don't have a break of the swing low. Ideally, I would like to see this swing low be broken, be breached, but price is trading below the 8 moving average line, and we are in this trade on a smaller time frame on the 1 hour chart. Stop loss would be above the swing point. Now, this area of resistance, that was a Fibonacci level. So if we take our Fibonacci tool, draw it from the swing high to the swing low, price did go up to 61%. This is very typical of divergence when price sells off, retraces to 61%, and then turns around and resumes its downward trend. I would ideally like to see a swing point be broken, but the next swing point is down here. So I'm not in this trade based on divergence yet. I'm mostly trading this based on the hourly chart, which is a continuation of the downtrend, and below this 8 moving average line, and the 2 lines of MACD have crossed to the downside. Now, when price gets all the way down to this trend line, then I would like to exit the trade and see if it breaks the trend line. If it does, then I would probably re-enter the market and sell. Just like we see on the New Zealand dollar, where a trend line was broken, even though we have divergence and the market has not retraced to a 61% retracement level, the trend line was broken, and that's what I mean about two different types of divergence setups. One, for example, here, where the market retraces to 61% and then resumes its trend to the downside, but has yet to break a trend line, and then one that has actually this, and I should take this back because this did retrace to a 61% retracement, and this is all the confirmation you need. Here's the swing low, here's the swing high, and there it is, this 61%. The market rallied, came back down to 61%. So this retracement is complete on this divergence, so it should continue to head north and hopefully hit our target today of 79.23 and then on to 79.95. But there's a 61% retracement level, I'm sorry, a 161 extension retracement level at that area of resistance, so that most likely the market will stall out and retrace. Here is a retracement, or rather a divergence on the Euro-Aussie dollar, and this is the daily chart, and this divergence started all the way back in October, and this is a lot better of a divergence setup. And let me explain. When price, we have divergence, then we have a break of a swing point. Here's a swing point that was broken right there. Then what happens? It's oversold and the market retraces, and let's see what Fibonacci level that is. It's more than like 78%. It's about 78% retracement level. 61 and 78% retracement levels are areas of resistance or support. If it breaks 78%, most likely the market will go and turn around and head the other way. But it did not do that. It hit its last Fibonacci percent and turned around and head south. So we are short on this trade based on this divergence setup that was started back in October of October 14th. Sold off, rallied, and now we're in a downtrend. This is a very important area because here's a trend line, and price is starting to break below that trend line. and that should continue. So when we see divergence setups on a daily chart, we're talking a possibility of weeks or months of reversal patterns. And let me just show you a few um, divergence on a daily chart that lasted weeks at a time. Here's a very good example on the same pair of a long-term divergence setup. Prior to this divergence, the market was clearly in a downtrend, rallied, came back down to create this divergence. So I connect the swing points. Now a swing point, remember, is a candle that is lower than the two candles to the right or more, or two candles to the left. So this candle right here is lower than the candles to the left and the candles to the right, making this a swing point, and that has to line up with a wave pattern. So the wave pattern lines up with the swing point. Remember that MACD, this is MACD, is a copycat of price. So if price goes down, MACD goes down. If price goes up, MACD goes up. But what happens is sometimes, and it's rare on a daily chart, is when the wave patterns are going in the opposite direction of price action. And in this example, we have wave patterns that are going in the opposite direction of the swing points. So what I like to do is that I connect the wave patterns and I connect the swing points, and notice that they're going in opposite direction. And then I'm waiting for a retracement or a trend line break, and in this case price never really retraced. It came back down to here, but look at this, the outcome of this divergence setup. The market continued to go up from November, this is November of last year, and continued to go up through December. So 2 months the market continued to go in an uptrend. And we're starting to see the same thing right now on this pair, on the Euro Aussie. Okay, we have divergence. Let's go all the way to here is the divergence setup. There's the retracement, and the retracement and this swing high technically should be the last place the market for the next few weeks or possibly a few months will visit. Okay, this is the area of resistance. The market should not go up to that level for the next few weeks, hopefully. So divergence, connecting the swing points, swing high. Here's a wave pattern. So we connect the wave patterns, and they are going in the opposite direction of the swing points. Here's a swing point and another swing point. Let me just highlight that so you can clearly see that this swing point is higher than these candles to the left and these candles to the right. So the swing point lines up very nicely with this wave, and this wave pattern lines up very nicely with this swing point here. If you don't have wave patterns that match up going in that opposite direction with price action, you don't have divergence. Okay, but this lines up really nice, sold off, retrace, and now we're in a downtrend. Great, I hope this helps. If you have any questions, please email me. Have a good trading day, and thanks for watching the video.